Kraft Heinz. I mean, the name is just about everywhere, right? In every pantry, every fridge across the country. But, behind that iconic ketchup bottle and the blue box of mac and cheese, the company has been really struggling. So now, after a seriously tough year, a new CEO is making this massive $600 million bet that he can turn it all around. So let's dive in. Let's break down what went wrong and exactly how they plan to fix it.
This quote right here from the new CEO, Steve Callahan, really tells you everything you need to know. He's not pointing fingers at the market or, blaming changing tastes. He's basically saying, hey, this is on us. We kind of broke it, so we can be the ones to fix it. It's a really bold statement of accountability, but it's also, incredibly optimistic. Okay, so to really get why this new plan is such a big deal, we have to look at the problems it's trying to solve. And to put it bluntly, 2025 was a year that I'm sure Kraft Heinz would love to just completely forget.
So the issue wasn't just in one little area. It was clear, and it was across the board. The company saw a really significant drop in revenue. That's the total money coming in the door, and in profit, which is what's left after all the costs. This wasn't just a tiny dip, you guys. They were losing market share, especially in their core U.S. business.
And here's the first number that really hits home. Their adjusted earnings per share, which is basically just a fancy way to measure how profitable the company is for each share of its stock, it fell by a staggering 15% for the whole year. For anyone invested in the company, that is a huge red flag.
And it wasn't just a full-year problem either. In the fourth quarter, which is always so critical, the company's revenue came in more than $23 million below what everyone was expecting. It really shows that this negative trend was actually picking up speed right when they needed to show some strength.
This chart here really gets to the heart of the issue. We're looking at a drop in adjusted gross margin. Now, the easiest way to think about that is it's the profit they make just on the products themselves, before all the other corporate costs. When that number starts going down, it means the very act of making and selling ketchup and mac and cheese is just becoming less and less profitable. It's a sign of a much deeper systemic problem.
So, you're facing all these grim numbers. What's the new CEO's take on it all? Well, he argues this isn't about the economy, or that consumers have suddenly changed their minds. The diagnosis is that the company's wounds are self-inflicted.
And that root cause, it has a name: underinvestment. The leadership is basically coming out and admitting that for the better part of a decade, the company just failed to put enough money back into its own business, into its iconic brands, into creating new stuff, and into its own sales and marketing teams. And here it is, from the CEO himself, loud and clear. He directly connects that history of underinvestment to the, quote, persistent share loss they've been seeing. I mean, for a CEO of a company this big, that is a remarkably candid thing to admit.
So if the problem is underinvestment, the solution seems kind of obvious, right? Invest more. But the scale of what they're planning is anything but obvious. Management announced two really bold moves that are now the backbone of their new strategy.
$600 million. That is the amount of new extra cash that Kraft Heinz is planning to pump into the business in 2026 alone. This is not a small adjustment, folks. This is a massive, massive bet on themselves.
The other big move was a real surprise. The company had been gearing up to split itself in two, but they've slammed on the brakes. And the logic? Well, it's that a successful turnaround needs every single person and every single dollar focused on one single mission. It is all hands on deck.
All right, so the big question is, where is all of this money actually going? A $600 million investment is great, but what's the strategy? Let's break it down.
What's really interesting here is just how simple this breakdown is. It is a clean 50-50 split. Half the money is going directly into the things that you and I actually touch and buy, improving the products, the packaging, and offering better prices. The other half is going into convincing us to buy it, marketing, R&D, and beefing up their sales force.
So this huge investment really supports three core ideas. First, innovate and just refresh their classic products. Second, get much, much better at actually selling and marketing them. And third, rebalance what they call the value equation so that we, the customers, feel like we're getting a great product for a fair price.
And hey, this isn't just some abstract corporate theory. They're boosting their R&D spending by 20% to launch actual tangible new products. We're talking about a Power Mac with more protein and fiber. We're talking about finally putting Capri Sun into single-serve bottles for places like convenience stores. And they're looking to take that iconic Heinz brand global, moving way beyond just ketchup into things like pasta sauces and other modern condiments.
Their pricing strategy is also getting a lot smarter. It's not just about putting things on sale. It's about being more strategic with their promotions, making sure they always have affordable entry-level products on the shelf, and in some cases, even lowering the base prices to pass those savings directly on to us.
And they're really quick to point out that this kind of focus can actually work. In the back half of 2025, they targeted just a few of their struggling brands. And the results? Well, consumption for Lunchables jumped 11 percentage points, Capri Sun went up by 7, and Mayo saw a huge 13-point improvement. These are the little green shoots they're hoping this new investment will turn into a forest.
Okay, so that's the plan. Sounds pretty solid, right? But here's the catch. The company is being incredibly direct that all of this spending is going to come at a short-term cost. It is going to be a year of pain before we see any potential gain.
They're essentially asking their investors for patience. They're saying, look, the 2026 financial results are gonna look rough, but they're framing it as a necessary trade-off. They have to absorb this cost now to build a much healthier, growing company for the future.
And here are the official numbers. This is their own forecast for 2026. As you can see, they're projecting organic net sales to be down somewhere between 0 and 2%. And even more telling, that adjusted EPS, that profitability metric we talked about, is projected to fall by as much as 15%. That right there is the direct, calculated financial impact of that $600 million bet.
Which of course leaves us with the big question. Kraft Heinz has diagnosed its problem as a decade of self-neglect. The prescription is a massive dose of cash and a ton of focus. But will a new, protein-packed mac and cheese and hundreds of millions of dollars really be enough to get this American icon growing again? Well, that is the $600 million bet they're making.